So, the yield curve is inverted. We've heard this a few times in recent years, but what does it mean? Well, the yield curve is a relationship between the rate on long-dated and shorter-term government debt. So an inverted yield curve is where the long-term rate falls below the shorter. And here's a hot tip for free. It's bad news. And typically, it's seen as a harbinger of economic slowdown that could eventually result in rate cuts. The problem the Fed has is that it's penned in by inflation. And yesterday, the yield curve inversion hit its lowest rate since 2007. And that's bad news for banks because it eats into their net interest margins, which is a measure of profitability for banks. It's sort of a ratio that compares the interest a bank earns compared to the outgoing expenditure it pays to its customers. And with bank earnings next week, it would definitely be something we recommend keeping an eye on. Well, anyway, credit markets are looking fragile right now, and if credit dries up, well, that's how recessions start. And with the Eurozone teetering on the verge of a brand new sovereign debt crisis, if a credit crunch begins, the worst case scenario and its contagion effects are pretty extreme, especially with the euro hitting dollar parity yesterday. If we're looking for a bottom line, we think that eventually the Fed will have to start easing, or at least slowing down on the tapering. But that doesn't mean any time soon. Inflation is in the forefront of their minds, and that's what they're going to focus on for now.